Good morning. Welcome to Stock Market Today. It's Friday, October 30th, 2020, and this is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today to sign up for a free email where we get a lot of the content for this show and also give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities finished higher in Thursday's trading, though off the best levels of the day. Treasuries were mostly weaker with the curve steepening. The dollar was stronger on the major crosses. Gold ended down 60 basis points and WTI crude settled down 3.3% and is off more than 9% on the week heading into the final day of trading. As we get to the desk this morning, S&P futures are down about 50 basis points, well off the worst levels of the overnight session. That's after Asian markets were lower overnight. European markets are mostly weaker as well. Treasuries are stronger with the curve flattening. Dollar is weaker against the yen. Little changed on the euro cross. Gold is up 30 basis points and WTI crude is up 0.5% to get us going on Friday morning after a big night of earnings last night, right? So if the bulls are going to keep the ball, as we said yesterday, they're going to have to start to mount a comeback here. Now, futures are under pressure. Earnings reports last night from Facebook, Amazon, and Apple were not well received. Google's report, however, was well received. The first three names trading down in the pre-market, Google trading higher. That's going to bring the Qs into focus. 260 is Q support, 280 is now resistance. Small caps, which have been resilient and been one of our barometers for increasing risk appetite in the market, consolidating here in the near term as well. 145-ish, 140, 145 is near-term support. So basically what we have here are key support levels for all of the major averages that, if broken, would turn trends to the downside. Now, they have not broken yet. There's been a lot of back and forth, but if we're just going to kind of take a step back and honestly look at the trends, especially in the SPY and the Q, it's still a consolidation within the context of an uptrend. Now, that consolidation is under pressure. There's no two ways about it. However, until 320 breaks on the Qs, until 260 breaks, until 320 breaks on the SPY, 260 on the Qs, it remains just that, a consolidation. Should those levels break, you would have a series of lower highs and lower lows that by definition would be a downtrend. So that's something that we are watching closely, especially in the Qs here this morning, which are going to be under pressure on the heels of those earnings reports last night that really come down to the fact that they just missed lofty expectations, right? Expectations have been mounting. Those stocks have been strong, right? And they just missed lofty expectations. So we'll see how it plays out over the next couple of days. So we have a macro picture, right, with COVID, with the election, stimulus, right, all bubbling on the back burner while we're in the heart of micro season, which is earnings. And this week really saw a huge amount of earnings reports where what we've seen, as I've written about and discussed, is the fact that the bar has certainly moved higher. So just watch those levels. That's the roadmap that we're using to develop our framework for the markets here going forward. Let's hit on our market in a minute. What are we writing about in the note today? Well, stocks did rebound yesterday to break a losing streak. The Qs are going to be in focus after those mega cap earnings missed lofty expectations. The growth value ratio, by extension, is under pressure. We've been talking about that for a while. Back in early September, we started highlighting the fact that it was extended. It's now consolidated. And if these growth stocks come under pressure, that ratio is going to come under pressure as well. Now, high yield is at resistance relative to treasuries. That's important from a risk sentiment standpoint in the market. And as I said, futures do point to a lower open here today. Taking a look from a power bar perspective at the major indices, everybody was higher yesterday, led by the Nasdaq. The Dow up 40 basis points, but still 1 to 7 bulls to bears over there. S&P 500 rallies by more than 1%. Ratio, though, remains bearish, 97 to 129 bulls to bears there. Nasdaq ratio is mixed, 18 to 19 bulls to bears, after adding 1.75% yesterday to outperform. Small caps also a slight outperformer, though 661 to 304 is a deterioration over the course of the week for the power bar ratio and small caps. Bonds downtick, sending yields higher. Energy, your best group yesterday, up 3%. However, look at that ratio, 1 bull to 11 bears for the energy complex. According to the Chaikin Power Bar, small cap stocks are more bullish than large cap stocks, and the major indexes across the board are mixed. Taking a look at our stock of the day now. Name that I'm highlighting here looks like it could present a compelling opportunity, especially if markets hold support. It's Decker's Outdoor Corp, ticker symbol DECK, closed at 257.77 yesterday, up a little over 3% for a stock with a bullish Chaikin Power Gauge rating, and is in a strong trend above the rising long-term trend line. The textile and apparel and luxury industry group is strong. Now, the stock did trigger one of our buy signals yesterday, our money flow buy signal. And if I take a look just purely from a technical structure, you can see some support here in the 220 to 225 zone. Chaikin money flow is solidly bullish. The stock is oversold as it outperforms relative to the broader market. So we have a bullish stock outperforming, becomes oversold as it consolidates just below 52-week highs. That's a pretty compelling setup for me, especially if the market holds. If SPY holds 320, these are the types of names that I think you want to be doing more work on and looking at as a potential bullish opportunities here in the near term. And if we stabilize above 320 and begin to move higher, I think stocks like this that have been leadership through the consolidation are likely to continue to be leadership once the market begins to move higher again. So take a look at a name like Decker's, which I'm highlighting in my note and here for you today. Looking at our sector tracker now, major sectors over the last 5 days of trading are all lower. Okay, so it just now at this point, it becomes a function of where is the relative strength, who's down less than the overall market. So there's comms, which are going to come under. Well, it could be mixed today, actually, because Google is strong. Facebook is weak. So some puts and takes for the comm services sector. Utilities have been an outperformer of late, something we've been watching. What I think we need to focus on from a market message standpoint is if the staples begin to get in gear as well, i.e. get in gear with the utilities. If both of those traditionally defensive areas of the market are beginning to outperform, you have to place higher odds on support breaking for the broader market. That's just kind of my view here in the near term. Real estate and discretionary round out the top four over the past 5 days of trading. Materials, staples, and tech are middle of the road. Healthcare, fins, industrials, and energy are at the bottom of the list. So despite the big move in energy yesterday, we have energy still at the bottom of the list. And that group is, I guess I just call it groping for a bottom, both on an absolute and a relative basis, and just not there yet by our work. It's something we're watching. It's something I'm certainly intrigued by. Sentiment certainly could not be worse on the group. A lot of people are paying attention to it. I'm paying attention to it as well, but the trend following discipline that I adhere to just doesn't warrant for getting involved and trying to catch that knife just yet. Our industry in focus today, capital market services, which until the past few days had actually been a bright spot within the financials. Now, over the past 6 months, the group has outperformed the S&P 500 by a little under 3%. Power bar ratio, which looks at future potential, is strong. We have 15 bullish stocks and 11 bearish stocks. That ranks it in the middle of the road, 10 of 21 subsectors having moved down one slot over the past week. But if I were to go looking for names on which to do more work, I would certainly be taking a look at Evercore, EVR, Cowen, COWN, Raymond James, RJF, all with very bullish Chaikin Power Gauge ratings, and are all holdings in a fund that, like I said, until recently was a bright spot within the financials. Bullish ETF rating, 15 to 11 bulls to bears on the ratio. Trend is strong above the rising long-term trend line. Money flow, we'd like to see it a little bit better or a lot better, really. But it is now oversold within the context of this uptrend, and it's outperforming. And this is what I've been saying. This is what I was meaning earlier. A bright spot within the financials here is we had this personality change. The rating turned bullish, and then shortly thereafter, the fund began to outperform. Under pressure with the entire market right now, but holding above the long-term trend line, where if you look at SPY, for instance, and even the Qs, they are below their measures of long-term trend. So If you're looking for opportunities within the financials, I think capital market services is a group on which to be paying some attention. Now, taking a look at what's trending now, yesterday's movers and shakers are gainers and losers. CBRE, a lot of this, predominantly all of this is earnings related, right? CBRE in the battered real estate space. So any whiff of good news there, or even just less bad news, can send the stock higher. And that's what happened yesterday with CBRE rallying by more than 16%. Twitter rallied into their earnings report, up 8% yesterday, but trading down about 15% in the pre-market after announcing results that disappointed the street. Tapestry TPR up 6.6%. Bullish rating there, continuing a trend of what we're seeing in some of these retail and apparel names. Martin Marietta earnings sent that stock higher by 6.5%, and LKQ, their earnings sent that stock higher by a like amount, about 6.4% on the day. The loser side of the board, Abiomed's earnings take 10% out of the stock. eBay, disappointing earnings there. They lose 7.5% for that very bearish stock. Fiserv FIS, down a little more than 5.5% following their report. Etsy earnings take it down 5%. Same goes for Ralph Lauren. RL with a very bearish rating, down 5% on the heels of their earnings announcement. And just kind of goes to show you that even the most iconic of brands can lose their luster sometimes. Ralph Lauren down 5% following their earnings report. Let's take a look at the charts now. On Fridays, we look at key themes and relationships to get a sense for risk appetite and what's the tone of the market. And, over the course of the past week, as you would expect, it's turned a little bit more cautious. If we look at the ratio of high yield bonds to treasuries, think about what that means, right? If you're willing to own high yield over treasuries, that's a sign of risk-seeking activity in the market. And that's really been playing out since those March lows to coincide with the uptrend in equity prices, actually retaking a declining 200-day moving average, but coming under some pressure in the near term. So, if you're equity bullish, you want to see this ratio do nothing more than just consolidate here before beginning to move higher and attack the levels that were in play at the tail end of last year. That would be a bullish development for the equity market, in my opinion. RSI of the ratio, not really tipping its hand one way or the other, hovering around the middle of the range. And you can get a clue from yields, right? As yields have backed up, 10-year treasury yields have backed up. That's largely coincided with this ratio moving higher. So if we see yields start to move lower, that would be a sign of some caution in the marketplace. So we're going to watch this as we always do. We write about it every Friday. I obviously keep an eye on it on a daily basis. But what I'm interested in is the trend. And, it was accelerated to the downside post-COVID snapback rally. So what I'm wondering is, a lot of these snapback rallies that we're seeing here, is it merely just a return to trend, right? Did COVID cause a massive dislocation to the downside? And then the snapback rallies are just getting us back to what was already a declining trend? I don't know, right? There's a lot of moving parts there and a lot to unpack, but I am seeing a similar dynamic at play through a lot of the charts and a lot of the ratios and themes that I look at, where it looks like the rally off the March lows may just be getting us back to a trend that was already in place. Let's take a look at tech now as actually growth over value is what we're going to look at here. But technology is going to have a big play here. Because technology is obviously growth, right? So the chart that we're looking at is the growth over value ratio, which has been consolidating. Remember, back in early September, we took a look at it and we said it was extended, and now it's done nothing but consolidate since then. But today could be a big day because those growth names, if they're under pressure, if they force a breakdown from this ratio, I think you have to start thinking about the 200-day moving average. So keep an eye on tech as a key theme within the growth over value relationship. Now, the RSI of the ratio has been marking a series of lower highs, and that's all playing out as the Qs, again, mostly tech, are consolidating relative to SPY, as we can see in the box on the lower part of the chart. And finally, speaking of, we'll take a look at the Qs in a little more depth here. 260 is the level, right? Right now, what we have is a lower high. And if we break 260, we would have a lower low. Now, we are oversold in the near term. Looking at the CCI and a 3-period moving average of the 13-period CCI shows us that we are oversold here in the near term. So as I said earlier, if the bulls are going to make a stand, they have to do it here. With those big earnings disappointing, we're going to watch that 260 level. That's going to wrap us up for the week. Have a great weekend, everyone. I'm back with you Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.